Are you offering employee benefits but have no idea what a Section 125 plan is? Then chances are you're pre-taxing those benefits without the proper legal setup. And that's no small mistake. It could mean IRS penalties, back taxes, and a whole lot of paperwork. Let's be real. The last thing you need is an auditor knocking on your door asking you why your deductions don't line up. A lot of business owners and HR managers assume that if they're offering health insurance, dental, vision, or accident coverage, they can just deduct those premiums pre-taxed and move on. But without a formal Section 125 plan in place, those deductions are non-compliant, even if your intentions are good. If you're not sure what a Section 125 plan is, check out my other video. I'll link it above and put it in the video description below. This video is about what happens when you don't have a Section 125 and pre-tax benefits. Let's talk about what could go wrong and how to avoid it. Before we dive into the risks, let's quickly recap what a Section 125 plan actually is, because it's the foundation for offering most employee benefits on a pre-tax basis. A Section 125 plan, also known as a cafeteria plan, is a specific IRS approved document that allows employees to pre-tax certain benefits like health, dental, vision, accident insurance before taxes are calculated on their paycheck. Without this written plan in place, those deductions are considered taxable income by the IRS, even if everyone assumed they were tax-free. It's not just a technicality, it's a legal requirement. The plan must be in writing, it must be adopted before any pre-tax deductions are taken, and it has to follow specific IRS guidelines to be valid. Skipping it or winging it isn't just risky, it's non-compliant. The issue is many businesses don't even realize they need this document until it's too late, like during a payroll audit or when preparing a year-end tax report. So if you're offering benefits and deducting premiums pre-tax, but you've never seen or signed a Section 125 plan document, there's a good chance you're already out of compliance. And that's where the problems begin. So what actually happens if you're deducting benefit premiums pre-tax, but don't have a Section 125 plan in place? The short answer: the IRS treats every single one of those deductions as invalid. So what does that even mean? It means that all those pre-tax amounts suddenly become taxable income, not just for the employees, but also for the business. And since this can be applied retroactively, you could be on the hook for back payroll taxes, IRS penalties, interest on unpaid amounts, and corrective filings with possible fines. And that's not all. If you're audited, the IRS could disqualify the entire benefits program for the year. That opens the door for amended W-2s, reprocessing payrolls, and some very uncomfortable conversations with employees who now owe more taxes than they expected. Plus, failing to comply can trigger issues with your accountant, your payroll provider, and even your benefits broker, especially if you certified that your setup was compliant, all because there wasn't a proper plan document in place. And here's the worst part: there's no grace for not knowing. The IRS expects you to get this right. It's a simple fix, but ignoring it can become a very expensive problem. So how do so many businesses end up in this situation? It usually starts with a misconception. Someone assuming that just offering group health benefits automatically makes pre-taxing deductions legal. Sometimes it's a payroll provider saying, "Don't worry, we've got it handled," without confirming whether a Section 125 plan document is actually in place. Other times, it's an employee benefits broker who fails to explain the requirements or doesn't help the employer put one in place at all. None of that even matters to the IRS. Even if a broker dropped the ball, it's still the company's responsibility to be compliant. Pre-taxing without a formal Section 125 plan isn't just bad advice, it's non-compliance. The IRS doesn't accept verbal agreements, HR software settings, or informal policies as a valid documentation. This mistake can fly under the radar for years, but when it's discovered, it's never a cheap or an easy fix. If you're not sure whether your company has a valid Section 125 plan in place, here's what to do next. Check your documents. You should have a written Section 125 plan document signed, dated, and adopted before any pre-tax deductions were taken. If you've never seen one, that's a red flag. Talk to your payroll provider and benefits broker. Ask if they've helped set a compliant plan, but don't just assume that it's handled. Ask to see the document and confirm that it's valid. If you don't have one, get one. You can work with a third-party administrator, a compliance-focused broker, or even an ERISA specialist to get everything set up correctly. Whatever route you take, make sure it's documented, up to date, and stored properly. Because once that plan is in place, you're protected. Without it, you're exposed and the IRS won't go easy. This is not about perfection. It's about covering your bases before a simple oversight turns into a costly compliance issue. If you're offering pre-tax employee benefits, you need a valid Section 125 plan in place, no exceptions. This isn't a technicality, it's a legal requirement that protects you, your business, and your employees from a costly mistake. Skipping it can trigger thousands in back taxes, IRS penalties, and serious administrative headaches, but catching it now, that's a win. If you found this video helpful, go ahead and hit that like and subscribe button. Thanks for watching, and if you have any questions, don't hesitate to reach out. You'll find my contact information in the video description below, and we'll see you in the next one.